Hi, I'm Toby, and today I'm going to be giving an overview of buy-to-let mortgages. Remember, I'm not a mortgage broker, so this is just general advice, and if you are strongly considering a buy-to-let mortgage, I highly recommend getting in touch with a qualified mortgage broker. So what is a mortgage? A mortgage is a secured loan, so different to an unsecured loan, such as a credit card. And what do we mean by secured? Well, in this instance, in return for the bank lending you the money, they will ask to secure that loan against the property. And in exchange for that security, they will offer you more favourable interest rates, usually around 1.6% up to 3.5% depending. And you can then use a buy-to-let mortgage to buy a property and let or rent it out for a profit. And you can do this in your personal name or using a limited company. And there are pros and cons for both, depending on your personal circumstances. And we highly recommend speaking to an accountant or a financial advisor who can be able to advise accordingly what may be best suited for yourself. Why use a buy-to-let mortgage? Well, it gives you leverage to increase your buying power. So how do we do this? For example, if you had £50,000 sitting in the bank, you can take this £50,000 and you could look to purchase a property worth £200,000. So how do we do this? Well, we can go and look to get a mortgage product which has a 75% loan to value. So this is where the lender will loan you 75% of the property value, which is going to be £150,000. Then you need to make up the rest, which is 25%, which is your pot of money here, £50,000, meaning you can then purchase an asset worth £200,000. So you've taken your £50,000 and you've turned it into an asset worth £200,000, which is also going to generate you income. Now, you can also use buy-to-let mortgages to increase your portfolio size a lot quicker. And how do we do this? Well, let's say we have somebody with £100,000, okay? They could go out and they could buy one property worth £100,000, okay? Cash outright, no need for a buy-to-let mortgage or loan, and they would own that outright. Or we could take their £100,000 and split it into 4 deposits for properties worth £100,000, because if we use a buy-to-let mortgage which has a 75% loan to value, we know the lender will loan us 75% of the property value, which is £75,000, and then we make up the rest, which is 25%, which is £25,000, and we can do that 4 times because we have the £100,000. So then, instead of one asset worth £100,000, we've got 4 assets worth £100,000. And this gets even better if the house worth £100,000 increases in value. So if we have capital appreciation. So let's say this property goes up in value by 10%. Well, that one property would give you capital appreciation of £10,000. Excellent. Now, if we have that same capital growth on these 4 properties, so the 10% uplift, you've got 1, 2, 3, 4 lots of that 10%. So 4 times the £10,000 capital depreciation experienced on each property gives you £40,000. So that just shows using buy-to-let mortgages to increase your portfolio a lot quicker. You've got 1 property, which gives you £10,000 capital depreciation, or you can have 4, which gives you 4 lots of £10,000, meaning you get £40,000 capital depreciation instead. Also, buy-to-let mortgages can help with your return on investment. So, how do they do this? Well, again, if we take the property you've bought for £100,000, and let's say this generates you £500 per calendar month, okay? So if we times that by 12, that means that property is generating us £6,000 per annum. So each year we receive £6,000 income from this property. So we can work out what our return on investment is by taking our income, which is £6,000, dividing it by the money that we invested, which is £100,000, and timesing that by 100, which gives us 6% return on investment. So that is 6% ROI, return on investment. So how does a buy-to-let mortgage increase your ROI? Well, the same property is bought using a buy-to-let mortgage. We have the £500 per calendar month. As we know, this gives us our £6,000 per annum, but we have a cost associated with that purchase because we have to pay the interest on that mortgage. So let's say the interest is £125 per calendar month. Times that by 12, it means the mortgage cost to us each year will be £1,500. So we need to deduct that cost from our income to give us our net income. So we will have £4,500. So you may look at that and say, well, that's less than that, so I must be better off buying it cash. Well, hang on a second. If we use that same formula, so we take our net yearly income, which is £4,500, we divide that by the money we invested. Now remember, we've only put 25% in because the lender is loaning us 75%. So we've only put in £25,000. We times that by £100. This means we're then generating 18% return on investment from the rental income. So that is triple what you would be getting if you bought the property cash. So that is how buy-to-let mortgages can really increase your return on investment. So what do lenders look at? Firstly, they look at you, the borrower. So they'll look at your lendability, your credit score, credit history, your income, your age, and what they look at and how strict they are for that criteria will differ from lender to lender. Some lenders require a minimum income, some lenders don't. So it will depend. Next, they'll look at the property itself, and they do this by sending out a RICS surveyor to go have a look at the property, determine its value to make sure that the price you're paying is correct, and they'll also look at the rental value as well. Remember, the lender is using that property as security, so that's why it's very important for them to send this RICS surveyor to make sure that they have the correct security. They will also put in place stress tests. So they'll do this by having a buffer on the rental income. That's to cover any sort of voids, additional costs, interest rate rises. So they will also have this stress test in place when looking at lending the money to you and against the property. There are two main types of mortgages: interest-only mortgage and a capital repayment mortgage. Interest-only mortgage is, well, it's in the description, you only pay the interest, and a capital repayment mortgage is where you pay the interest and you pay a chunk of the money owed each month. So at the end of the mortgage term, you'll have paid the lender back the money that you owed them. Whereas with an interest-only mortgage, you still owe the money that you borrowed at the end of the term because you've only been paying the interest on that loan. So if you borrowed £100,000 on an interest-only mortgage basis, at the end of the mortgage term, you would still owe that £100,000. So what do you do when you reach that point? Well, there's a few options. You can sell the property and use the proceeds of that sale to pay the lender their money back. And usually, if there's been capital appreciation, you will have profit left over once you've paid them the money back. You can use other capital to pay the lender their money back. So you might have some stocks and shares, other assets, or money built up, which you'll use to then pay them. Or you can remortgage the property. And you can do this by going to another lender. You can remortgage with the same lender, and this is where you'll refinance that debt. So they are the options that you have if you come to the end of your interest-only mortgage. Lastly, we're going to go over the main things to consider when looking at buy-to-let mortgages. You need to consider loan-to-value, or LTV, and this can range anywhere from 60% up to 80%. You need to consider whether it will be a fixed rate mortgage or a variable rate mortgage. Variable rate mortgage will fluctuate up and down. A fixed rate mortgage is where you lock in the interest rate for a certain period of time. It could be 2 years, 5 years, 10 years. And lastly, you need to consider the interest rate itself. You need to make sure that it's a manageable rate for you, and there are different rates out there depending on the lender and the product itself. So I hope that's been helpful to give you a brief overview of buy-to-let mortgages. If you have any questions, please feel free to get in touch. Thank you.